So you've decided to no longer trade your time for money, and it's high time to start using your business to generate some additional wealth. On this episode of the Tax Talk podcast, we are going to look at exactly that, how to move from just being an employee in your business to being an actual business owner, and how that is going to overall impact your wealth and your ability to generate a lasting legacy. Let's do it. Welcome to episode 43 of the Tax Talk podcast. As always, your host, Jared Poulon for Legacy Accounting in Red Deer, Alberta, Canada. What are we talking about on this episode? Building wealth. So in episode 42, we looked at kind of the initial stages of that business, how to build a strong foundation that you can rely upon, how you can use that to ultimately build a cornerstone for wealth generation via your business. Now we've gotten to the point where we've got a strong business foundation. We want to ensure that we are now using our resources, our time, and our efforts to not just collect some revenue on an hourly basis, but to hire some employees, etc., and start generating some wealth for ourselves that we can ultimately pass on to, our family, our kids, and things of that nature. So when we're looking at the wealth aspect of things, we need to first look at the structure of the business. So a lot of times you might start out as a sole proprietor. Typically, this is what I would advise a lot of business owners to do, especially if you're just kind of getting into this for the first time. It's a lot easier to start that business as a sole proprietorship as opposed to going down the path of being incorporated. It gives you some flexibility in those early years. If you generate some losses, you can claim those against other income on your personal income tax return. And overall, the complexity, the requirements from a tax reporting side, the legal reporting side are much simpler to take care of. And for a lot of business owners first getting started, this might be the appropriate way to begin your business. But what happens if you have gotten down the road a little ways? So sole proprietorship is now becoming very successful. Maybe you were just doing it as a side hustle to begin with, but it's gotten to the point where you can quit your everyday job and just focus on this full time. Typically, what I like to see from clients is, you're grossing at least $100,000 of revenue. Probably in today's age, with inflated prices on everything, we could probably bump that number up a little bit. But that would kind of be your baseline number to look at and say, once I'm getting into this neighborhood, is it maybe beneficial for me to now consider going and incorporating this business? The other aspect that you may want to consider that has nothing to do with tax is just the overall liability within your business. If there are, services that you provide or goods that you're selling that may carry some sort of inherent liability, risk, or issue with it, it may be beneficial to incorporate as well to ensure you're providing a bit of separation between yourself and the business as far as the legalities of everything. So when you're getting to this point in time, as far as wealth generating goes, if you are reporting the entirety of this business income on your personal tax return, the net income is going to be taxed based on your marginal tax rate. So if you are able to retain some of the profits within that business, it might be then beneficial to look at incorporation. As a result of incorporating, if you're running an active business within that corporation, the income would then be taxed at 11% as opposed to whatever your marginal personal rate is. And if we're just looking at the bottom end tax bracket, so that gets you up to about $55,000 of income on the personal side, that alone is going to be taxed at 25%. So if you're able to retain profits in a corporation instead of the sole proprietorship, with the intent of using those funds to continue to build the business, you're going to be far better suited to have those funds taxed into the company and then reinvest those that way. On to the next one. Maybe you've now gotten down the road quite a ways. You've built up a successful business over the course of, even a few years if things have gone exceptionally well. You are now starting to retain some of those profits within the company, and you maybe are starting to buy up some investments, or you have some just extra cash laying around. Essentially, you're starting to collect what accountants, or for better purposes, CRA would deem passive investments. And those are, like I mentioned, some of those assets that are not being used on a regular day-to-day basis in the generation of active business income within your company. So if this is occurring, you could potentially be throwing yourself offside for what is called the lifetime capital gains exemption, and more notably, the tests for qualified small business shares. So what you may need to do at this point in time is determine that I've got a bunch of excess profits here. They're turning into passive assets. If I leave these in my company any longer, I'm going to fall offside of these QSBC rules. And if I want to sell my shares or pass them on to the next generation, I'm going to throw myself offside of the lifetime capital gains exemption, thereby missing out on the ability to claim that, which, based on updated legislation, is going to be up to $1.25 million. So it would be very irresponsible of you in the overall wealth generating plan to not take the steps to ensure that your business is able to use this exemption if that opportunity comes along. So what is it that you need to do to ensure that your business does qualify? You would potentially want to then set up a holding company and move all of those passive assets from your operating company over to the holding company. This would allow your operating to become what is called purified for CRA's guidelines, whereby all of the assets in that business would then again be used in the generation of active business income. And then you could set it up in such a manner that you could flow after-tax profits from your operating company up to the holding company on a tax-free basis. In the holding company, then, you would be able to continue to invest those excess profits in whatever form you so choose. And then you've got a division that not only helps you for tax purposes, but also provides that extra layer of liability protection, where if your operating company is subject to a lawsuit, you have moved all of the retained earnings and the equity up into that holding company, and there's far less for creditors to come after you in that operating company. So what we ultimately want to see is that you are able to reinvest in your business. So in that, initial stage, when you're looking at the foundation, you're essentially an employee. You're going to work every day, trading your time for money. This is a good way to start. It gives you some flexibility. It gives you the ability to pursue your goals and dreams. But ultimately, if you leave your business in that state, you're never going to be anything more than an employee, just working via a corporation as opposed to working directly for that particular company or companies that you're working for. So then you want to move yourself into the owner role. So you hire a few employees to be able to take on some of the tasks that you previously were taking care of. This allows you to focus your time and efforts on not only working in the business, but working on the business and seeing that you can grow the business and generate some wealth because you are now making money off of the efforts that the employees are inputting into that business. And ultimately, every business owner's goal should become an investor within that business, whereby you are not inputting any of your time into the day-to-day operations of that business. You are merely, the investment advisor, the driver of the strategy of the business, and you focus your time entirely on generating wealth, moving that business to the next level, as opposed to actually doing the work that that business does or selling the goods that that business sells. So that should always be every business owner's intent, to become an investor in that business. So in getting from some of these early stages to the point where you're able to generate wealth, make sure you have a good idea about the financial requirements of your plan. So, like we mentioned in the previous episode, there are different ways to collect some of the financing that you might need. Obviously you might inject some cash to begin with. You might be able to get a loan from family or friends, or at some point in time, once the business has established some credit, you may be able then to get a loan from a typical, bank lender of that nature. So my, usual thoughts on this is, if you are having to inject some cash into the business, that's a good way to see a return on your money. I think you're far more motivated to see those funds grow than you would be if you go and park them in a GIC and earn 3 or 4% each year. I think you are far more motivated to see a better return on your money than the bank is willing to offer you. But at some point in time, you want to ensure that you don't just have your personal cash tied up in there and sitting in a checkings account or something like that within that corporation, because those funds aren't doing anything for you. So what are some of the options that you have when you've got some of that excess cash and profits built up in that holding company? So the two big ones that I like to typically touch on are investing in some sort of stock portfolio or buying some real estate. So as far as a stock portfolio goes, need to take these with a grain of salt, I guess, based on recent legislative changes. So with the increase in the capital gains inclusion rate from 50% to 2/3, you need to be aware of what you're holding within that corporation. If you are purchasing a stock portfolio that is returning, funds back to you by way of capital gains on a regular basis, these are not going to be taxed as favorably as they were in previous years. So it might be beneficial within your corporation to, generate dividend income. That way, any of the dividends flowing through that stock portfolio can then be taxed based on the corporate rates, but you could pay dividends out to yourself to kind of flow through that refundable tax to yourself. So to me, of the interest, dividends, and capital gains that typically are seen from a stock portfolio, based on the way that legislation is mapped out currently, I would say it would be most beneficial to find stocks that are going to pay you dividend returns as opposed to capital gains, which rates have bumped up, or versus interest, which is fully taxable and thereby not as conducive in the generation of wealth within that corporation. So kind of keep that in mind. Ensure, like we mentioned in the previous episode, you get a good investment advisor on your team that can kind of help you look at the entire picture to ensure that you are planning your wealth generation strategy correctly. Up next, and I think this one, it just holds true no matter what happens in the markets. It's investing in real estate. Now, obviously, you're going to get some blips here and there. Prices never stay stagnant, but over the course of time, real property just inherently increases in value. So if you can find some property, whether it's, residential, commercial, whatever, fits your investment strategy best, and potentially buy those within your holding company, or if it makes more sense, pull some funds out of your holding company and then hold those properties personally. I would strongly advise that you add some real estate investments into your overall wealth generating portfolio. Not only can you generate some short-term cash flow from it, but the appreciation that you get from these properties that translates into long-term wealth that you can then pass on to your kids is a very tangible and realistic way to get from point A to point B. So again, important to talk probably to a number of different individuals in this aspect. Most of all, I would say speaking with us here at Legacy, just to ensure that you are buying that property in the right entity. Again, you have to kind of keep into consideration the increase in those capital gains inclusion rates. So when you eventually do sell that piece of real estate, currently as it stands, individuals having a lower inclusion rate for those first $250,000 of gains in the first or in each individual year, whereas every dollar in the corporation of capital gains is included into income at 2/3. So it might be wise to take some funds out via dividends from that holding company and then purchase that property individually, maybe in joint title with your spouse, so you can ultimately split that gain if there's no issues in getting some funds out of that holding company to your spouse. Again, something that needs to be discussed with Legacy to ensure you're not falling offside on the TOSI rules. So there's just a lot of intricacies that need to be attended to ensure that you set up the proper plan to take the steps to go from just working as an employee within your corporation up into that business owner where you have a few employees working for you, and then ultimately up to that top level where you're an investor in that business and you're just focusing on, keeping that business purified for tax purposes. You're determining the best way to move it forward so you can generate more profits and thereby keep flowing wealth into that holding company to build those non-active investment portfolios and ultimately be able to then turn that into a pension. And that will be what we are looking at in the next video, ways to use your small business as a pension vehicle for you and your spouse into retirement. So that wraps it up for this episode of the Tax Talk podcast. If you have any questions on this material, please feel free to touch base with me, Jared, Jared, at legacyllp.ca. Also, feel free to check out our website, legacyllp.ca. Go into the ebook section. We have a link there for the planning process ebook, where it summarizes not only the information that we talked about today, but the previous episodes, and then the following two that are coming up, where we look at pension and estate planning. So, for Jared Poulon, thanks again for watching. Take care, and we'll talk soon.